Every country on Earth owes money. The United States alone is buried under more than $38 trillion in debt, the highest amount in its history. The European Union carries about $14 trillion, and Japan nearly $9 trillion. Even countries that seem wealthy, like Saudi Arabia with its oil, or export giants like Germany and China, also owe massive sums. But here's the strange part. If every country is in debt, who is everyone actually borrowing from? Debt isn't just a problem or a burden, it's become the framework that holds the modern world together. Every war, every economic boom, and every financial crisis rests on this invisible structure built from IOUs. And if you trace those debts far enough, you find something surprising. The world doesn't owe money to one single person or country, it owes it to itself. But that doesn't mean everyone wins equally. Some benefit far more than others. To understand how we reached this point, a planet drowning in more than $315 trillion of total debt, almost 3 times the size of the entire global economy, we need to look back at where it all began. Long before credit cards or online banking existed, the idea of national debt was born, not in Wall Street, but on the battlefield. In 1694, England was locked in a war against France and running out of gold to pay for it. Desperate, the king turned to wealthy merchants for help. In return for a steady stream of interest payments, guaranteed by future taxes, they agreed to fund the crown. To manage this deal, a new institution was created, the Bank of England. It was a revolutionary idea. For the first time, a government could spend money it didn't yet have. And in return, lenders received something valuable, a promise from the state. That promise could be bought, sold, or traded. This was the birth of the government bond, the seed of the entire modern financial system. Other nations quickly followed. France adopted the model, the Netherlands improved it, and the newly independent United States used it to finance its revolution and later its westward expansion. Debt soon stopped being a sign of weakness and became a symbol of trust. The power to borrow became the power to rule. Empires once conquered land to take gold. Now they issued bonds to collect interest. The battlefield had moved from soldiers and swords to balance sheets and ledgers. Jump ahead 300 years and debt has become the world's biggest export. The United States alone owes around $38 trillion. Japan owes more than $9 trillion. And globally, total borrowing grows about $1 trillion every 100 days. Every nation owes money. Every bank lends it. And every citizen, through taxes, savings, or pensions, is both a debtor and a creditor at the same time. But who actually sits on the other end of this massive financial chain? Let's start with the United States, because its debt isn't just national, it's global. Out of that $38 trillion, about half is owed to investors, not to other parts of the government. Roughly 2/3 of those investors are Americans, including banks, pension funds, mutual funds, insurance companies, and even the Federal Reserve itself. The remaining 1/3, roughly $9 trillion, is held overseas. Japan is the largest foreign holder, owning around $1 trillion in U.S. debt. China comes next with about $800 billion, followed by the UK, Luxembourg, and Belgium. So when people claim that America is in debt to China, it's technically true, but only for about 2% of the total. The vast majority of U.S. debt is actually owed within America itself. Here's how the cycle works. The U.S. Treasury issues bonds, banks and funds buy them. Later, the Federal Reserve often buys those same bonds back, creating new dollars in the process. Then, American taxpayers pay interest on those bonds, money that flows back into American retirement accounts and investments. It's like looking into a financial mirror. The debt is real, but most of it is owed to the same system that created it.
This financial loop isn't just an American phenomenon, it's global. Japan lends money to the United States by buying U.S. Treasury bonds. The U.S. then lends to Europe through the IMF. Europe, in turn, lends to developing countries through the World Bank. And those developing nations often lend right back to rich countries by storing their foreign reserves and investing in Western bonds. It's like a worldwide circle of credit, a massive chain where everyone owes someone else. Think of it as a global game of hot potato, except the potato isn't cash, it's a bundle of promises. Every country is holding another country's IOU, and every promise depends on someone else's promise being kept. It's also like a poker game where every player has borrowed chips from the next. The game keeps going only as long as no one decides to walk away from the table. But there's another layer to this system, and it's the most powerful one of all: the markets. Behind every government bond lies a vast network of financial institutions: hedge funds, pension funds, sovereign wealth funds, and central banks, managing tens of trillions of dollars in assets. These are the real gatekeepers of global credit. They decide which nations can borrow easily and which must pay higher interest just to stay afloat. And when their confidence disappears, currencies crash, governments fall, and entire economies can be reshaped in a matter of days. In simple terms, democracy may choose who governs, but markets decide who survives. At the center of this financial universe stands the central bank, the ultimate market maker. Institutions like the Federal Reserve or the European Central Bank don't just manage debt, they actually create it. Every time they buy government bonds, they're creating new money in exchange. What shows up as a liability on one balance sheet becomes an asset on another. That means every dollar, coin, or digital balance in existence represents debt somewhere else in the system. In our modern world, there's no such thing as debt-free money. Every dollar carries an invisible IOU written into the fabric of the financial system itself. For decades, this entire system has survived on one fragile foundation: confidence. As long as investors believe that governments will keep paying the interest, even if the principal is never fully repaid, the gears of the debt machine keep spinning. But when that belief fades, everything can unravel fast. Take Greece in 2010. When investors realized the government couldn't repay its debts, panic spread. Bond prices collapsed, yields shot up, and the European Central Bank and IMF rushed in with a bailout. But that rescue came with a heavy cost: austerity. Taxes were raised, public spending was slashed, and unemployment soared. For a whole generation, the word bailout came to mean sacrifice. In Argentina, years of repeated defaults turned national debt into a kind of curse, a cycle of hope and collapse that never truly ends. And in Sri Lanka, when the government ran out of foreign currency to pay its loans, it led to fuel shortages, protests, and political chaos. When the debt system cracks, the once hidden players suddenly come into view: the IMF, the credit rating agencies, and the anonymous bondholders who can hold entire nations by the throat. And yet, even after every crisis, the pattern starts all over again. Old debts are restructured, new loans are issued, and the same machine starts running once more, just with a new name on the same balance sheet.
In the 21st century, debt isn't meant to be fully repaid. Instead, it's designed to be rolled over. Governments today don't plan to clear their debts. Not now, not ever. This isn't a conspiracy, it's standard policy. When you or I borrow money, we're expected to pay back the full loan. Governments work differently. They treat debt like a subscription service, issuing new bonds to pay off old ones, a process economists call refinancing. The real product isn't the loan itself, but the interest, the rent charged for stability. The global economy now runs on that rent, like a shark that must keep swimming to survive. This system depends on confidence, not actual repayment. The United States will never pay off its $38 trillion debt. It will refinance it indefinitely. Japan has been rolling over its debt for decades, now exceeding 250% of GDP, yet its government bond yields remain near zero. Investors aren't waiting for repayment, they're waiting to renew the agreement. Why? Because government debt is considered the safest collateral in the world. A U.S. Treasury bond isn't just a liability, it's an asset. It forms the foundation of global financial markets. Pension funds hold it, banks use it as security, central banks even treat it as money itself. The global financial system relies on governments never fully paying off their debt. If they did, the world would lose its most trusted financial asset. Imagine if Washington suddenly decided to pay off every last dollar of the U.S. debt. Banks and investment funds around the world would instantly lose their safest holding. The dollar supply would shrink dramatically, causing deflation and potentially triggering a full-blown economic collapse. Paying off the debt would destroy the very engine that makes the economy run. Instead, governments do the opposite. They continue issuing new debt, not recklessly, but in a steady, predictable rhythm. Debt has become a kind of heartbeat for capitalism, flowing through every pension, mortgage, and financial market on Earth. That's why when politicians talk about balancing the budget or paying down national debt, it's mostly an illusion. The real goal isn't to eliminate debt, it's to keep it manageable, serviceable, and trusted enough so that the system continues to function. Once that trust disappears, the numbers stop mattering. Confidence collapses, interest rates spike, and the global economy, built entirely on rolling promises, grinds to a halt. Here's the truth about sovereign debt. The plan was never to fully repay it. The real goal is to keep the world believing it can be repaid. It's a closed loop built entirely on trust. As long as that trust holds, the numbers can grow indefinitely without causing a collapse. But that trust isn't shared equally. When we say the world owes it to itself, that's only partly true. The interest payments on debt don't flow evenly through society. They mostly move upward, from taxpayers and workers to the institutions and investors who actually hold the debt. In other words, debt isn't just a transfer between nations, it's a transfer between classes. This is why global inequality and global indebtedness tend to rise together. The system rewards those who own debt and places the burden on those who simply pay it. If this sounds familiar, it's because it's the same story at every level, from households to countries, and from countries to the global economy. Creditors aren't villains, and debtors aren't victims. They are two sides of the same engine. The real problem comes when the engine runs out of fuel, when new borrowing can't keep up with the promises already made. That's when the question, who is the creditor, stops being abstract and starts to matter personally. At the top of this global pyramid, there's no single face to blame. It isn't just China, Wall Street, or the IMF. It's all of them, and all of us. The modern financial system has essentially turned debt into money. Governments issue it, banks multiply it, investors trade it, and ordinary citizens depend on it. The line between debtor and creditor has almost disappeared. Debt, which once meant bondage, now functions as balance. But if that balance ever tips, if confidence collapses, the illusion ends, and the world is reminded what debt really is, a promise that can't last forever. Don't miss what history is trying to teach us. Hit subscribe before it's too late.